Most people grow up believing money is something physical, something printed, something produced carefully by governments and distributed into the economy like water through a pipe. Bills and coins feel real in the hand, and because they feel real, people assume money itself must be rooted in something solid beneath the surface. But modern money is not primarily paper. It is accounting. It is balance sheets. It is promises layered upon promises inside a global system of coordinated debt creation. And that changes everything. The misunderstanding begins early. Children are taught that central banks print money. News anchors repeat the phrase every recession. Politicians blame inflation on money printing. Financial commentators point toward stacks of currency or images of giant printing presses whenever economies enter crisis. Yet physical cash today represents only a tiny fraction of total money in existence. Most money exists nowhere physical at all. No vault contains it, no truck transports it, no mint manufactures it. It exists as digital entries inside banking systems, numbers simultaneously appearing on one balance sheet and another. The overwhelming majority of modern money is created not when governments print bills, but when commercial banks issue loans. That is the real engine. And most people never see it happen. The process looks deceptively simple. A person walks into a bank seeking a mortgage. Perhaps they want to buy a home in Calgary, Manchester, Sydney, or Dallas. The borrower assumes the bank will lend out money that somebody else previously deposited there. The image most people carry in their minds is old-fashioned banking. Savers place money into vaults, banks store it, then lend portions out carefully. But modern banking systems do not work that way. When a commercial bank approves a loan, it usually creates brand new deposit money at the exact same moment. The bank types numbers into existence. Simultaneously, two things appear: an asset for the bank, the loan owed back with interest, and a liability, the deposit credited to the borrower's account. Money is born through debt, not transferred, created. This idea sounds almost conspiratorial the first time people hear it, yet it is openly acknowledged within modern central banking literature itself. Institutions like the Bank for International Settlements, the Bank of England, and the Federal Reserve System all describe versions of this mechanism in public research papers and monetary explanations. Commercial banks are not merely intermediaries moving existing money around the economy. They are creators of money, and once you understand that, entire economic systems begin to look different. Housing booms look different. Asset bubbles look different. Inflation looks different. Recessions look different. Because economies are not merely circulating money. They are constantly manufacturing and extinguishing it through credit expansion and repayment. The modern financial system is therefore less like a warehouse and more like a living organism, expanding when credit grows, contracting when loans disappear. Every mortgage issued expands the money supply. Every business loan expands it further. Every line of credit injects new purchasing power into the system. And when loans are repaid, that money effectively vanishes. Destroyed through accounting reversal. The implications become enormous once scaled globally. Entire eras of economic growth often correspond not to productivity alone, but to massive expansions in debt creation. Cheap credit fuels rising real estate. Rising real estate fuels collateral growth. Collateral growth fuels more lending. More lending creates more money. More money chases assets. Asset prices rise again. And the cycle reinforces itself. This is why modern economies often feel permanently dependent on growth. Because debt-based monetary systems require continual expansion to remain stable. If lending slows dramatically, the system begins to seize. Businesses cut spending. Consumers retreat. Asset prices weaken. Banks tighten standards. The money supply stops growing. And suddenly economies that looked healthy begin trembling underneath. What most people call economic confidence is often deeply tied to the willingness of banks to continue expanding credit. This is where central banks enter the picture. Central banks do not usually create most money directly for consumers. Instead, they influence the conditions under which commercial banks create money. They act more like system managers. Interest rates become steering mechanisms. Raise rates and borrowing slows. Lower rates and lending accelerates. The goal is not simply controlling inflation. The goal is maintaining stability in a system fundamentally built upon expanding and contracting debt. That balancing act has become increasingly fragile in the modern era, especially after 2008, especially after pandemic-era stimulus, especially as global debt levels reached heights unimaginable only decades earlier. By the early 21st century, the world economy had become a vast interconnected architecture of leverage, liquidity, collateral, sovereign bonds, derivatives, and credit markets layered atop one another. And quietly sitting above much of that architecture was an institution many people have never even heard of: the Bank for International Settlements, often called the Central Bank for Central Banks. A quiet institution headquartered in Basel, Switzerland. No election campaigns, no nightly television debates, no public spectacle. Just economists, regulators, banking officials, and monetary coordination operating largely beyond public attention. The BIS helps coordinate international banking standards, reserve frameworks, liquidity requirements, and financial stability measures between nations. Its influence is subtle but profound because modern banking systems are globally interconnected. Credit shocks in one country can rapidly infect others. And in a debt-based monetary world, confidence itself becomes one of the most valuable assets on earth. Because modern money ultimately depends on belief. Belief that loans will be repaid, belief that banks remain solvent, belief that governments can stabilize crises, belief that currencies will hold value tomorrow. The entire structure functions because billions of people collectively accept these digital obligations as real. And most never stop to examine how the system actually works beneath the surface. They simply participate. Paychecks arrive. Mortgages get approved. Credit cards function. Homes rise in value. Retirement accounts grow. And the machine continues expanding. Quietly. Relentlessly. Mostly invisible. Until suddenly it isn't. For most of human history, economic growth moved slowly. Painfully slowly. Empires rose and collapsed across centuries, while ordinary people often lived lives nearly identical to those of their grandparents. Wealth existed certainly, but financial systems remained constrained by physical limitations: gold reserves, silver coinage, harvest cycles, transportation bottlenecks, and the simple inability to expand credit at industrial scale. Then, modern banking changed the speed of everything. Not overnight, not through a single conspiracy or secret decision, but gradually through the evolution of financial systems that discovered something extraordinarily powerful. Future income could be borrowed into the present. That realization transformed civilization. Once banks learned they could create money through lending, economies no longer needed to wait for physical wealth accumulation before expanding. Growth could be accelerated through credit itself. Factories could be financed before profits existed. Railways could be built before trade volumes materialized. Homes could be purchased decades before buyers fully earned the money. Governments could spend against future tax revenue. Entire societies could pull tomorrow's economic activity forward into today. And for long stretches of time, it worked astonishingly well. Credit expansion became one of the great engines of modern prosperity. The industrial age accelerated alongside increasingly sophisticated banking systems. By the 20th century, consumer finance exploded. Mortgages reshaped suburban development. Corporations expanded through debt issuance. Nations financed wars, infrastructure, welfare systems, and technological revolutions through ever-growing layers of credit creation. Economic growth and debt growth became deeply intertwined. In many countries, total debt began rising faster than GDP itself, and few people noticed. Because during expansion phases, debt often feels indistinguishable from wealth. When home prices rise, homeowners feel richer. When stock markets surge, investors feel wealthier. When businesses can borrow cheaply, hiring expands. When governments stimulate economies with deficit spending, recessions soften. The entire machine appears functional, healthy even. But underneath, something subtle begins happening in debt-driven economies. The system slowly becomes dependent on continuously expanding credit to maintain stability. That dependence creates a strange paradox. Growth requires debt, but too much debt eventually threatens growth itself. This tension sits at the center of modern economics. And nowhere is it more visible than in housing markets. Housing is one of the clearest examples of how commercial bank lending directly shapes society itself. When banks loosen lending standards and lower borrowing costs, buyers suddenly gain access to larger mortgages. More purchasing power floods into the housing market almost instantly. But housing supply moves slowly. Construction takes years. Land remains limited. Zoning restrictions constrain development. So instead of merely creating more homes, expanding credit often creates higher prices, which leads to one of the defining features of modern economies: asset inflation. Not necessarily inflation in bread or milk at first, but inflation in houses, stocks, commercial real estate, financial assets, things heavily purchased using borrowed money. This is why periods of low interest rates frequently coincide with asset booms. Cheap borrowing increases the ability to bid up prices, and rising prices create optimism. Optimism encourages more borrowing. More borrowing creates more money. More money pushes prices higher again. The feedback loop strengthens. This process became increasingly global after the late 20th century. Financial liberalization allowed capital to move rapidly between nations. Banking systems interconnected. Sovereign debt markets expanded massively. Pension funds, hedge funds, insurance companies, and multinational banks all became intertwined inside one enormous global credit ecosystem. At the center of this ecosystem sat central banks attempting to manage impossible trade-offs. If they kept interest rates too high, economies could slow into recession. If they kept rates too low for too long, debt bubbles could inflate dangerously. And because modern economies had accumulated enormous debt loads, even small interest rate increases could suddenly threaten financial stability. This became painfully obvious during the 2008 financial crisis. The crisis itself was not merely about irresponsible mortgages. It was about the fragility of highly leveraged credit systems. For years beforehand, banks issued enormous quantities of mortgage debt. Those mortgages were bundled into securities, sold globally, leveraged further, insured through derivatives, and embedded throughout the international financial system. As long as housing prices rose, the machine appeared stable. But when defaults began spreading, confidence collapsed, and in modern banking systems, confidence is everything. Banks became afraid to lend to one another. Liquidity evaporated, asset prices crashed, credit creation froze. Suddenly, the system that created money through lending began doing the reverse. Credit contraction, money destruction, central banks responded aggressively. Interest rates collapsed toward zero. Emergency liquidity flooded markets, governments launched bailouts, and institutions like the Bank for International Settlements coordinated international regulatory responses designed to prevent total systemic breakdown. One of the major outcomes was the creation of stricter banking capital standards known as Basel III. The idea was simple in theory. Banks needed larger cushions against future shocks, more reserves, stronger liquidity positions, less dangerous leverage. But the deeper issue remained unresolved. Modern economies still depended heavily on credit expansion for growth, and after 2008, central banks entered unfamiliar territory. Historically, low interest rates persisted not for months, but for years, then for more than a decade in some countries. Cheap money became normalized. Investors searching for returns moved into riskier assets. Governments accumulated more debt. Corporations borrowed heavily. Consumers stretched further into housing markets, and global debt levels climbed to historic highs. Then came the pandemic era, and the system accelerated dramatically. Governments around the world launched extraordinary stimulus programs. Central banks purchased vast quantities of bonds and financial assets. Trillions in liquidity entered global markets within astonishingly short periods of time. For a while, financial markets soared. Housing prices exploded upward across many countries. Speculative assets surged. Everything seemed liquid. Everything seemed supported. Until inflation returned with force. Because while modern money creation often first inflates assets, eventually enough liquidity can spill into the real economy itself. Consumer prices rise. Wages chase costs. Central banks suddenly face another impossible balancing act: Raise rates to fight inflation, but risk destabilizing debt-heavy economies. Or keep rates low and risk inflation becoming entrenched. This is why modern central banking often feels reactive rather than fully controlling events. The system itself has grown extraordinarily complex. Too much tightening risks recession. Too much easing risks bubbles and inflation. And beneath all of it lies the same underlying mechanism most people rarely see: commercial banks creating money through expanding credit. A process so normalized that entire civilizations now depend upon it continuing indefinitely. Because once economies become structured around ever-expanding debt, slowing the machine becomes extraordinarily dangerous, not just for markets, but for governments, for pensions, for employment, for housing, for political stability itself. And that is the uncomfortable reality underneath modern finance. The system does not merely encourage growth, it increasingly requires it. To most people, central banks appear almost godlike. When inflation rises, they raise rates. When economies weaken, they lower them. Markets tremble when central bankers speak. Entire industries react to a few carefully worded sentences delivered at podiums in Washington, London, Frankfurt, Tokyo, Ottawa, or Basel. News channels dissect every phrase. Investors search for hidden signals in the language itself. It creates the impression that central banks fully command the modern economy from above. But the reality is stranger and far less certain, because central banks do not directly control the economy in the way many people imagine. They influence it, steer it, nudge it, sometimes stabilize it temporarily, sometimes destabilize it unintentionally. But modern financial systems are now so enormous, interconnected, and debt-dependent that even central banks often appear to be reacting to events rather than fully controlling them. To understand why, you first have to understand what central banks actually are. A central bank is fundamentally a manager of monetary conditions. Its responsibilities usually include maintaining currency stability, managing inflation, supporting employment and economic growth, stabilizing financial systems during crises, supervising aspects of banking and liquidity, acting as lender of last resort when panic spreads. Institutions like the Federal Reserve System, the European Central Bank, the Bank of Canada, and the Bank of England all operate within variations of this framework. But one of the greatest misconceptions about central banks is that they directly hand out most money in the economy. They usually do not. Commercial banks still create most broad money through lending. What central banks primarily control is the environment in which that lending occurs, and the most famous tool they use is the interest rate. Interest rates are not merely numbers. They are pressure valves for the entire global financial system. When central banks lower rates, borrowing becomes cheaper. Mortgages become easier. Corporate loans expand. Governments finance deficits more affordably. Consumers spend more freely. Asset prices often rise. Economic activity accelerates. But lowering rates also encourages more leverage, more debt, more speculation, more risk-taking, and eventually, potentially, more inflation. Raising rates does the opposite. Debt becomes more expensive. Borrowing slows. Housing markets cool. Businesses delay expansion. Consumers reduce spending. Economic growth weakens, but inflationary pressures may ease. This balancing act sounds manageable in theory. In reality, it has become extraordinarily difficult because the modern world accumulated so much debt during decades of low-rate expansion. Debt changes how economies react to interest rates. In heavily indebted systems, even small increases in borrowing costs can create enormous stress. A homeowner renewing a mortgage at 2% experiences one reality. That same homeowner renewing at 6% experiences another entirely. Multiply that across millions of households, corporations, governments, and financial institutions simultaneously, and the sensitivity becomes immense. This creates a dangerous dependency. Central banks become trapped between competing risks. Raise rates aggressively, and you risk recession, defaults, unemployment, banking instability, and falling asset markets. Keep rates too low, and you risk inflation, speculative bubbles, currency weakness, and distorted financial behavior. The problem becomes even harder because modern economies are driven heavily by expectations. Financial markets do not merely react to present conditions, they react to anticipated future conditions. Investors constantly attempt to front-run central bank decisions, which means central banks are now partly managing psychology itself. Confidence, fear, expectation, narrative. This is why language matters so much in monetary policy. A single sentence from a central banker can move trillions of dollars globally within minutes. Because modern finance is deeply interconnected through leverage and expectation. This became painfully visible during the years following the 2008 crisis. After rates collapsed toward zero, central banks entered territory rarely seen in modern history. Traditional rate cuts were no longer enough, so they introduced extraordinary measures. One of the most important was quantitative easing, often called QE. Quantitative easing sounds technical and distant, but its effects reshaped global markets profoundly. Under QE programs, central banks purchased massive quantities of government bonds and financial assets from markets. In exchange, they injected new reserves into the banking system. The goal was to stabilize markets, lower long-term interest rates, encourage lending, and prevent economic collapse. And at first, it appeared highly successful. Financial markets recovered, banks stabilized, credit conditions improved. But QE also transformed the relationship between central banks and financial markets themselves. Markets increasingly began assuming central banks would intervene whenever major instability emerged. A kind of monetary safety net appeared beneath global finance. And once markets believe rescue is likely, behavior changes, risk appetite increases, speculation expands. Asset prices climb further. This phenomenon became so common that investors even developed expressions for it, phrases implying central banks would always support markets during severe downturns. Whether entirely true or not, the belief itself became influential, because modern markets are heavily psychological systems. Then came another consequence. Years of ultra-low rates and QE pushed investors outward in search of returns. Government bonds yielded little, so capital flowed into equities. Technology stocks, private equity, luxury housing, commercial real estate, crypto speculation, venture capital. Risk expanded everywhere. Cheap money encouraged almost everything to become more expensive simultaneously. And while consumer inflation remained relatively subdued for years, asset inflation surged dramatically. This widened inequality in many countries. People who owned appreciating assets often became vastly wealthier. Those relying primarily on wages struggled to keep pace. Younger generations found housing increasingly unreachable. Financial wealth concentrated further upward, and all of it remained connected to the same underlying mechanism: sustained credit expansion supported by extraordinarily loose monetary conditions. Then inflation returned after the pandemic era. Suddenly, central banks faced the exact scenario many had feared for years. Prices rose rapidly across goods, energy, housing, food, transportation, and services. And because inflation threatened public confidence in currencies themselves, central banks were forced to respond aggressively. Rates rose at speeds not seen for decades. Markets convulsed. Bank failures emerged in some regions. Bond markets destabilized. Housing markets weakened. Governments faced sharply rising borrowing costs. The illusion of effortless control began fading, because central banks cannot create real productivity. They cannot manufacture oil, food, labor, housing supply, or industrial output directly. They influence financial conditions surrounding those things. But the deeper structural realities of economies remain extraordinarily difficult to manage through monetary policy alone. And behind the scenes, institutions like the Bank for International Settlements monitor these pressures globally. The BIS often warns about systemic risks building quietly beneath long periods of cheap credit: debt accumulation, leverage, shadow banking, liquidity mismatches, fragile bond markets, interconnected exposures. Because the modern financial system increasingly resembles a tightly stretched web, strong during calm periods, potentially unstable during shocks. And perhaps the strangest part of all is this: the more debt accumulates inside the system, the harder it becomes for central banks to normalize conditions without causing damage. Which means modern economies may not simply be addicted to growth. They may also be addicted to cheap money itself. By the early 21st century, the global economy had become something humanity had never seen before. Not merely industrial, not merely digital, but financialized. Almost every major system on Earth had become tied to debt markets in some way. Housing markets depended on mortgage credit. Governments depended on bond issuance. Corporations depended on refinancing. Pension funds depended on asset appreciation. Banks depended on continuous liquidity. Consumers depended on installment financing. Entire countries depended on maintaining investor confidence in sovereign debt. Debt was no longer just a tool inside the economy. Debt had become the architecture of the economy itself, and the scale became staggering. Global debt eventually climbed into the hundreds of trillions of dollars when combining government, household, corporate, and financial sector obligations. The numbers grew so large they stopped feeling comprehensible. Trillion became ordinary language. Deficits, once considered catastrophic, became politically routine. But the most important aspect was not simply the size of debt. It was interconnectedness. Modern finance operates like an enormous layered network of obligations stacked atop one another. Banks lend against collateral. Institutions borrow against securities. Governments issue bonds purchased by pension funds and central banks. Derivatives hedge risks created by other derivatives. Insurance structures support leveraged positions financed through overnight funding markets. Everything becomes connected, which means instability can spread with astonishing speed. This is one reason institutions like the Bank for International Settlements spend so much time monitoring systemic risk rather than merely isolated bank failures. Because modern crises rarely remain isolated anymore. A housing collapse in one country can destabilize banks elsewhere. A sovereign debt panic can infect pension systems internationally. A liquidity shortage can spread globally within hours. Confidence itself has become contagious, and so has fear. One of the clearest examples of this interconnected system is the sovereign bond market. Government bonds are often treated as the foundation of modern finance. Nations issue debt to fund deficits, infrastructure, military spending, healthcare systems, social programs, and crisis responses. Investors purchase these bonds because governments are generally viewed as relatively safe borrowers. But sovereign debt serves another critical role beyond financing governments. It acts as collateral throughout the global financial system. Banks hold government bonds as reserves. Institutional investors use them in lending markets. Financial contracts price themselves relative to sovereign yields. Central banks use them for monetary operations. The entire system depends heavily on the assumption that major government debt remains trustworthy and liquid, which creates an extraordinary paradox. Modern financial systems require ever-growing debt issuance, but also require continued faith that the debt remains sustainable. That balancing act grows harder as debt accumulates, especially when interest rates rise. During long periods of ultra-low rates, governments can carry enormous debt burdens relatively comfortably because borrowing costs remain manageable. But when rates increase, refinancing becomes far more expensive, and governments are not alone. Corporations refinancing debt face higher costs. Homeowners renewing mortgages face payment shocks. Commercial real estate becomes vulnerable. Banks holding older low-yield bonds face balance sheet stress. Everything tightens simultaneously. This is why rate hikes in heavily indebted economies often create delayed instability. The pressure moves slowly at first. Then suddenly. This phenomenon became visible in multiple banking shocks during the post-pandemic inflation era. Institutions holding large quantities of long-duration bonds discovered that rapidly rising rates had sharply reduced the market value of those assets. On paper, the losses looked manageable, until depositors became nervous. Then liquidity pressure emerged. And in modern banking systems, liquidity crises can spread faster than almost any other type of panic. Because money now moves digitally, instantly. Historically, bank runs involved crowds outside branches. Today, billions can leave institutions through smartphones in hours, which means confidence cycles move at technological speed. This creates enormous pressure on regulators and central banks to intervene quickly during instability. Modern financial systems are so interconnected that policymakers increasingly fear allowing major disorderly collapses. And markets know this, which creates another dangerous dynamic. If investors believe governments and central banks will always intervene during crises, risk behavior changes. Excessive leverage can build quietly because participants assume rescue mechanisms will eventually appear. Economists often call this moral hazard. But in practice, the situation becomes politically complicated because allowing major collapses can trigger unemployment, pension losses, housing crashes, and social instability. So policymakers repeatedly face terrible choices: intervene and encourage future risk-taking, or refuse intervention and risk systemic contagion. The deeper the debt structure becomes, the harder those decisions grow. This is partly why central banks and international regulators increasingly focus on financial stability as much as inflation itself. Because in modern economies, financial instability can rapidly become economic instability. And economic instability can quickly become political instability. Housing affordability crises reshape elections. Inflation destabilizes governments. Bank failures erode trust. Debt crises fuel populism. Entire political movements now emerge from financial conditions many citizens barely understand beneath the surface. This is where the modern debt machine becomes more than economics. It becomes social architecture. When asset prices rise faster than wages for decades, younger generations delay families and home ownership. When debt burdens increase, populations become financially fragile. When governments rely heavily on deficit spending, political systems become dependent on continual borrowing capacity. When pension systems require high asset returns, markets become structurally pressured toward perpetual growth. Everything becomes tied to maintaining expansion. And yet infinite expansion inside finite systems creates unavoidable tension. Even central banks quietly acknowledge this tension at times. Reports from institutions like the Bank for International Settlements frequently warn about excessive leverage accumulating during prolonged periods of easy money. The language is often technical and understated: liquidity vulnerabilities, credit imbalances, systemic exposures, macroprudential concerns. But beneath the sterile terminology lies a simple fear: that modern financial systems may have become too dependent on continuously rising debt and asset prices to function normally without intervention. And if that is true, then the system most people think of as stable may actually be in a constant state of managed instability, not collapsing, not fully healthy, but continuously requiring adjustment, support, refinancing, liquidity injections, confidence management, and coordinated intervention to continue functioning smoothly. A machine too interconnected to stop easily, and too large to fully control. Every monetary system eventually changes, sometimes slowly across generations, sometimes violently within years. History is filled with currencies that once appeared permanent. Empires once believed their financial systems represented the final stage of civilization. Roman coinage dominated trade routes for centuries. European colonial powers projected monetary influence across continents. Gold standards rose and fell. Bretton Woods reshaped global finance after the Second World War. Fiat currencies untethered themselves from gold. Digital banking replaced physical cash for much of daily life. At every stage, people living inside those systems usually assumed the structure surrounding them was normal, stable, permanent. And yet money is ultimately a social technology, a collective agreement, which means it evolves alongside power, politics, technology, and trust itself. Today, the global financial system stands at another possible turning point. Not necessarily collapse, not necessarily revolution, but transition. Because the pressures building beneath the modern debt-based monetary system continue growing more difficult to ignore. Debt levels remain extraordinarily high. Populations are aging across many developed nations. Housing affordability crises worsen. Productivity growth has slowed in parts of the world. Political polarization intensifies, Geopolitical fragmentation is increasing, and central banks are now attempting something historically very difficult: containing inflation while maintaining stability inside debt-heavy economies. The challenge is enormous because modern systems became accustomed to decades of falling interest rates and expanding liquidity. From the early 1980s onward, interest rates generally trended downward across much of the developed world. Every major slowdown often brought easier monetary conditions. Borrowing expanded. Asset prices rose. Debt accumulated further. Entire generations of investors, governments, corporations, and households adapted to this environment. But history does not always move in straight lines forever. If inflation remains structurally higher in the future, due to energy transitions, deglobalization, demographic pressures, labor shortages, geopolitical conflict, or supply chain fragmentation, then maintaining permanently low interest rates may become far harder. And that creates tension inside a world built on debt expansion. Because higher rates expose fragilities, they reveal which businesses survive mainly on cheap financing, which governments struggle under refinancing pressure, which housing markets depended heavily on ultra-low borrowing costs, which financial institutions assumed liquidity would remain endless. The future may therefore involve a long balancing act between inflation management and financial stability. But another transformation is also quietly emerging: digital money itself. For decades, most money already existed electronically inside banking systems. But now governments and central banks are exploring entirely new forms of currency infrastructure: central bank digital currencies, CBDCs. Unlike decentralized cryptocurrencies, CBDCs would represent state-backed digital money issued directly within central banking frameworks. Different countries are experimenting with different models, but the implications could be profound. Instant settlement systems, programmable money, reduced dependence on physical cash, potentially greater visibility into transactions, faster policy transmission, lower payment friction. Supporters argue these systems could modernize finance dramatically. Critics worry about surveillance, control, privacy erosion, and centralized financial power. And underneath the debate lies a deeper reality. Money is becoming increasingly digital, trackable, and integrated into technological systems. Meanwhile, private financial technologies continue evolving rapidly as well. Cryptocurrencies emerged partly from distrust following the 2008 crisis. The launch of Bitcoin reflected a growing desire among some individuals for alternatives outside traditional banking systems. To supporters, decentralized currencies represented protection from inflationary monetary policy and centralized financial control. To critics, they represented speculative volatility and unstable monetary experimentation. Regardless of viewpoint, their emergence signaled something important. Public trust in traditional monetary systems was no longer unquestioned, and trust is ultimately the foundation beneath all money. This is why institutions like the Bank for International Settlements increasingly focus not only on banking stability, but on the future structure of money itself. Cross-border payment systems, digital settlement layers, cybersecurity, stablecoins, liquidity infrastructure, international coordination. Because the future financial system may look significantly different from the one built during the 20th century. At the same time, artificial intelligence and automation may further reshape monetary systems in ways still poorly understood. If productivity rises dramatically through automation while labor demand changes unpredictably, governments may face enormous pressure to rethink taxation, welfare systems, and monetary policy entirely. Questions once considered fringe increasingly enter mainstream discussion. Universal basic income, direct digital stimulus payments, programmable fiscal policy, automated taxation systems, machine-managed financial optimization. The line between monetary policy, technology, and governance may blur further. And yet, despite all the complexity, the deepest reality underneath money remains surprisingly simple. Money is trust organized at scale, not gold, not paper, not digits alone. Trust. Trust that wages will retain value. Trust that banks remain solvent. Trust that governments endure. Trust that debts will be honored. trust that future purchasing power will still exist tomorrow. Once trust weakens severely, monetary systems destabilize quickly. This is why inflation frightens policymakers, why banking panics spread so rapidly, why sovereign debt crises become existential. Because beneath the equations and financial instruments lies something fundamentally psychological: human belief. And perhaps that is the strangest part of the modern system most people misunderstand. Money is not merely an economic tool, it is one of the largest shared belief systems ever created. Billions of people wake each morning and collectively participate in it without thinking deeply about how it functions underneath. Paychecks arrive, transactions clear, loans expand, debts accumulate, markets fluctuate, central banks intervene, and the machine continues moving forward. Immense, invisible, complicated enough that even many professionals inside it disagree about how stable it truly is. But whether the future brings inflationary eras, digital currencies, financial fragmentation, renewed regulation, or entirely new monetary structures, one reality seems increasingly clear. The future of civilization may depend not simply on how much money exists, but on whether people continue believing in the systems creating it.